What if I told you that silver just wiped out 40% of its value in less than 2 weeks? And the way it happened over the weekend should terrify every single person holding this metal right now. Between Friday close and Monday open, we saw gaps that defied logic, price action that broke every rule in the book, and a liquidation event so violent that $1.28 trillion in value just vanished. And here's what nobody's talking about. This wasn't some random crash. This was structural. This was the market showing you exactly how the game is rigged. And if you don't understand what just happened, you're going to get destroyed in the next move. You're about to discover why silver gapped the way it did over the weekend, understand the exact mechanics that caused 40% of value to evaporate while you were sleeping, and walk away knowing the 3 critical things you must do right now, whether you're holding silver or thinking about buying this dip. And by the end, you'll see why the next gap could be even bigger. Drop a comment right now telling me if you're holding silver or if you sold during the crash, because I need to know where you stand. I've been tracking precious metals for over a decade, and I can tell you with absolute certainty, what happened to silver between late January and now is one of the most extreme moves I've ever witnessed. Silver hit an all-time high of $121.64 per ounce. Let that sink in. $121. Then, in a span of days, it crashed to $74. That's not a correction. That's not profit-taking. That's a liquidation cascade that exposed every single weakness in how this market actually operates. So let me break this down step by step. Because there's been a lot of talk about silver lately, and honestly, most of it is complete nonsense. People keep saying this was manipulation, that the banks did this, that China caused it. But here's what they're missing. The real story is about how weekend gaps in precious metals reveal the true nature of liquidity, and why the invisible hand of the market becomes a sledgehammer when nobody's watching. Here's the thing. Silver doesn't trade like stocks. It doesn't trade like crypto. It operates in a world where physical metal, paper contracts, and futures markets are all dancing together, and when the music stops on a Friday afternoon, everything changes. Most people have no idea that silver markets essentially go dark over the weekend. Sure, you've got some weekend spot trading on certain platforms, but the big liquidity, the real depth, the market makers who provide the cushion, they're gone. Friday, 5 p.m. Eastern, the major futures markets close, and they don't reopen until Sunday night. Now here's where it gets interesting. When silver closed on Friday, January 31st, it was still riding high, hovering near all-time record territory. Investors went into the weekend feeling good. Then Sunday night happens. Markets reopen, and the price gap's down. Not a gentle slide, a gap, meaning there's literally no trading, no price discovery between Friday's close and Sunday's open. You go to bed thinking your position is worth X. You wake up, and it's worth X minus 20%. No warning, no ability to exit, just a gap that swallowed your capital. Let me give you a simple example. Imagine you're driving on a highway and suddenly there's just no road for the next 2 miles. You don't slow down and stop, you just fall. That's exactly how weekend gaps work in silver. When liquidity disappears and sentiment shifts, there's no support structure. The price just finds the next level where buyers are willing to step in. And if that level is way down here instead of up there, you're done. That's exactly what happened. And this is important. These gaps don't happen in a vacuum. What's happening is that when silver hit $121, the rally had become completely detached from reality. I'm not saying silver doesn't have long-term value. I'm not saying the bull case is dead. What I'm saying is that in January 2026, we witnessed one of the most parabolic moves in silver's history. The metal rallied 144% in 2025 alone. Then in January, it jumped another 60% in a single month. 60% in 30 days. That's not normal price discovery. That's euphoria. That's speculation. That's leverage piling on top of leverage. And here's what ties this all together. China announced export restrictions on silver back in late December. The market freaked out. Everyone assumed supply was going to get choked off. Retail investors piled in. Institutions loaded up. Silver ETFs saw record inflows. Futures open interest exploded. And stay with me here because this is crucial, China had actually implemented similar restrictions back in 2019, and their exports didn't meaningfully decline. In fact, China's silver exports in 2025 hit 5,100 tons, the highest in 16 years. The supply crisis everyone feared. It wasn't real, but the price moved like it was. Now let's talk about what happened when reality started creeping back in. Microsoft reported earnings. Great earnings, actually, but the stock dropped 11% in a single day. Why? Because investors looked at the massive AI spending, the capital expenditure, and said, wait a second, when does this actually turn into profit? Tech stocks tumbled. The NASDAQ fell over 2%. The S&P 500 pulled back. And suddenly, risk off turned into risk really off. When volatility spikes across all assets, investors don't rotate into gold and silver. They de-risk everything. They sell what's up to cover what's down. And silver, which had just gone vertical, became the obvious profit-taking target. Here's where this gets crazy. Once the selling started, market structure took over. Gold and silver markets today are heavily intermediated by banks, ETFs, futures markets, and algorithmic traders. When volatility spikes, these players don't step in to provide liquidity. They step back. Market makers widen their spreads. Algorithms hit their risk limits and shut down. Liquidity, which was already thin going into the weekend, just evaporated. And when liquidity disappears in a falling market, prices don't drift lower, they gap lower. This is what nobody talks about. The silver market isn't some conspiracy. It's a structurally fragile market that operates on leverage, where most of the trading volume is paper contracts, not physical metal, and where the participants providing liquidity have every incentive to step aside when things get volatile. You want to know why silver dropped 40% while gold only dropped 9% at its worst? Because silver's market is smaller, more leveraged, and more speculative? It's that simple. Let me show you something. Between Friday close and Monday open during the worst of this crash, silver gapped multiple times. You'd see the futures reopen Sunday night, immediate gap down. Then another leg lower Monday morning in Asia. Then another when London opened. Then another when New York came online. Each gap represented a zone where there were literally no bids, no one willing to catch the falling knife. And if you were holding a leveraged position, a futures contract, or even an ETF that tracks the daily moves, you got obliterated. Margin calls went out. Forced liquidations kicked in, and that selling created more gaps. Now pay attention to this. The US dollar also played a role here. After declining 9.25% over the prior 12 months, the dollar stabilized and started edging higher in February. Why does this matter? Because gold and silver are priced in dollars. When the dollar strengthens, precious metals get more expensive for international buyers. Demand pulls back, and even a modest move in the dollar can pressure metals prices at the margin. Add that to the fact that the Federal Reserve confirmed a pause in rate cuts, which removed another tailwind from metals, and you've got a perfect storm of sentiment shift, liquidity drain, and structural weakness all converging at once. Here's the part nobody talks about. Industrial demand for silver started cracking under the weight of high prices. Silver is used in electronics, batteries, and solar panels. It's a fantastic conductor, but it's not irreplaceable. When silver hit $100, then $110, then $120, manufacturers started doing the math. And in January, one of China's largest solar panel makers, LONGi Green Energy, publicly announced they're switching to base metals to cut costs. Think about that. 60% of silver demand is industrial. If the biggest users start substituting silver with cheaper alternatives because the price got too high, what happens to long-term demand? It collapses. And when the market realizes that, speculative longs don't stick around. Now here's the twist. This wasn't the first time silver did this. Let me take you back to 2011. After the financial crisis, silver rallied hard on fears of currency debasement, inflation, and sovereign debt concerns. Sound familiar? It peaked near $50, then crashed back down to $30, then $20, then $15. The pattern was identical. Massive rally driven by macro fear and speculation, parabolic move, euphoria, then reality. The difference this time is the starting point was higher and the crash was faster. You might be thinking, okay, but is this a buying opportunity? Let me stop you right there. History says be very, very skeptical. Every single time silver has gone parabolic over the last 50 years, it has given back the majority of those gains. The metal has entered bubble territory 3 other times in modern history: 1980, 2011, and now. Each time, the macro story was compelling. Currency fears, inflation, geopolitical risk. Each time, the rally felt different, and each time, prices eventually normalized back toward levels driven by actual industrial supply and demand, not speculation. Here's what's really going on. Silver entered 2026 with incredible momentum. Prices had more than doubled. Retail investors were euphoric. Then the cracks appeared. The Chinese export restrictions turned out to be overblown. Industrial users started substituting. The dollar firmed up. Equities sold off. And the crowded trade, which had become absolutely packed with leveraged longs, had nowhere to go but out the door. When that door is only open a few hours over the weekend, you get gaps. Massive, violent, portfolio-destroying gaps. Let me give you the key that unlocks all of this. Weekend gaps in silver aren't just about timing, they're about structure. The precious metals market operates across multiple time zones, multiple exchanges, and with participants who have wildly different motives. You've got physical buyers in Asia, algorithmic traders in New York, market makers in London, central banks, hedge funds, retail investors. When all of them are active and providing liquidity, the market can absorb shocks. But shut down the major exchanges for 48 hours. Let sentiment shift, let fear build, and when the gates reopen, it's chaos. This is crucial. This is the difference between understanding how markets actually work versus believing they should work a certain way. Silver doesn't care about your thesis. It doesn't care that you bought it as an inflation hedge. It doesn't care that you think it's undervalued relative to gold. When liquidity dries up and the crowd heads for the exit, your position gets repriced based on where the next willing buyer is standing. And if that buyer is 40% lower than where you entered, that's your new reality. Pay close attention because this is the breakthrough. The weekend gap phenomenon in silver tells you everything you need to know about the risk of holding leveraged or large positions in thinly traded markets. Yes, silver trades billions of dollars a day during regular hours. But strip away the market makers, shut down the futures exchanges, and let sentiment turn, and that liquidity is an illusion. It's there when you don't need it. It's gone when you do. So let's recap what you now know. Silver hit an all-time high of $121, driven by speculation and fear of supply shortages that never materialized. The rally was parabolic and unsustainable. When equities sold off and volatility spiked, investors de-risked everything. And silver, being smaller and more leveraged than gold, got hit hardest. Weekend gaps exposed the lack of liquidity and forced liquidations. Industrial users are now substituting silver with cheaper alternatives because prices got too high. The dollar firmed up, removing another tailwind. And this exact pattern has happened 3 times before in the last 50 years, with the same result every time: mean reversion. Moving forward, when you see silver gap violently over a weekend, you'll know to watch for forced liquidations and margin calls cascading through the following sessions. When industrial users start announcing substitution plans, watch for long-term demand to crack. When the rally becomes parabolic and everyone you know is talking about silver, that's not the beginning, that's the end. You're now ahead of the curve. You understand what most people are going to miss, that silver's crash wasn't a conspiracy, it was market structure eating itself alive. The gaps weren't manipulation. They were the natural result of a crowded, leveraged trade meeting zero liquidity at the worst possible time. I want to hear from you. Are you still holding silver after this crash, or did you get out? And more importantly, do you think this is a buying opportunity or a warning sign? Drop your take in the comments because I read every single one and I'm genuinely curious where you stand on this. If you got value from this, hit subscribe because I'm breaking down gold's next move and whether the same gaps are about to hit that market next week. And trust me, you don't want to miss it. The patterns are already forming. Remember, when everyone's telling you to buy the dip in a market that just lost 40% in 2 weeks, ask yourself, where's the actual liquidity? Because if it's not there on a Tuesday afternoon, it sure as hell won't be there on a Sunday night. And when the next gap comes, and it will come, you'll know exactly what to do. Don't be the liquidity. Be the one watching from the sidelines until the structure stabilizes. The bottom line is this: silver showed you its true nature. It's not a safe haven. It's not a store of value. It's a volatile, leveraged, structurally fragile speculation that can gap against you faster than you can react. If you're going to hold it, size your position like it could lose half its value over a weekend. Because it just did, and it can do it again. I'll see you in the next one.